Thank you for joining me for a look at Google and history. And I do often turn to history to try to understand today's market, so if that interests you, please subscribe to my YouTube channel below. Now, Google, as you know, is more than a search engine, and they have their money and engineers in almost every aspect of our lives that we allow them into. And it's difficult to imagine going a day without using Google in some way. That makes them kind of like a utility when you think about it. So a public utility is an organization that provides the infrastructure for basic public services. Electricity is clearly a utility. It powers everything in our house. And if you have some degree of smart home, Google may power quite a bit in your house. Google Maps, Google other products definitely have created this backbone at a time when basic broadband internet services is also being considered a utility. They're natural monopolies in the sense that they just grew that way. And maybe it was natural to assume a company would grow to meet all of your data needs. So it is possible regulators could step in. And in the 1920s, we saw regulators step in to ensure access to electricity. Electric companies were privately owned, and they had no problem getting service to people living in cities. It was profitable. They were running the lines to the factories, which were their primary customers at the time, and just dropping extra wires into homes along the way. It made absolute sense. However, it didn't provide access to the infrastructure that electricity offered. So in 1935, the government stepped in, and within 20 years, electricity was a universal service. So this is slow moving. It impacts a number of companies, and it impacts them over a long time. Google could definitely become regulated, and this lends itself to trading opportunities. Now, looking back at the 1920s, when electric companies were in their heyday, so to speak, relative strength strategies were popular. And relative strength strategies can be complex. That is one of the reasons they're not widely used by individual investors. To implement a relative strength strategy, you often have to short stocks, you have to calculate data and indicators for a number of stocks. It requires programming and data skills that are beyond the time limits an average individual investor has. There's a shortcut. You can just put a simple rate of change indicator on a chart and a number of free websites. Here's an example. This is a simple 52-week rate of change. So if the price of Google is higher today than it was 52 weeks ago, it's a buy. When it's negative, it's a sell. So when the price of Google is lower than it was 52 weeks ago or a year ago, it's a sell. The chart highlights the few sell signals. It's a slow-moving indicator that keeps you in for the majority of the trend. You'll have some drawdowns, but the worst drawdown is less than 20% historically since Google began trading in 2004. Simple strategy to basically sidestep the worst of the bear markets. Tech's problems are going to become apparent as time goes by, that regulators do need to step in and consider that question. Are some tech companies utilities or other entities that deserve regulation? And as that happens, relative strength strategies are going to come to the fore. And you're really going to be able to just trade these rather than wonder whether you should buy or sell. When you hear news, you're not going to have to say, does this mean I should buy? You're going to be able to look at a chart and say, the data tells me it's a buy, or the data says it's a sell, and I'll get my signal when the time comes. So you have a straightforward system. Very few rules, easy enough to follow. I'll be covering additional ideas like this from time to time. So again, if you like to learn about things like this, please consider subscribing to my YouTube channel by clicking below. Thank you.